energy prices are up, then we have household budgets have been squeezed from multiple directions. The RBA has moved the interest rate twice in about 8 weeks time, right? And then we also have the data that shows consumer confidence sitting at cycle low. Now here is something that does not make the front page every day. The RBA is not saying that this is going to last forever. There is a concept in property psychology called FOB, fear of buying early, okay? It's the internal voice that says that what if prices fall more? The forces that are creating fear in the market right now are the same forces that are making the structural case for well-located property stronger, not weaker, okay? Stronger. What you're actually waiting for is a feeling that the world has settled down enough to feel safe to act. Now, understand this, property cycle does not care about feelings, okay? It moves on its own logic. You have supply and demand, migration, infrastructure, right? And right now, across right pockets of this country, those structural fundamentals are pointing in one direction, okay? Let me show you the numbers. Okay, so the best property decisions I've ever seen clients make did not happen when things were going well. They happen in moments where most people were too nervous to pick up the phone. Right now is one of those moments. For example, energy prices are up. We all know that. Then we have household budgets have been squeezed from multiple directions. The RBA has moved the interest rate twice in about 8 weeks time, right? And then we also have the data that shows consumer confidence sitting at cycle low. Most people watching this are feeling some version of the same thing, right? Is now really the time, right? That question, that hesitation is exactly what I want to talk to you about today, because the answer is not as simple as yes or no. It depends entirely on what is sitting underneath the noise. And when you look at what is actually underneath it right now with real data, the picture is very different to what most people are seeing, right? So let's look at the real environment, the real psychology, and then you can decide for yourself, right? Let's just be honest about the environment. On the 17th of March, the RBA hiked the cash rate from 3.85% to 4.10%. That is 25 basis points. The second consecutive hike, and it was a split decision, right? 5 board members voted to raise, 4 voted to hold. That tells you something very important, right? This was not anonymous, right? There is genuine debate happening inside the RBA about where we go from here, right? Now, the reason they moved the interest rate twice in the last couple of months, okay? Inflation picked up in the second half of 2025, and then what happened in the world, right? For example, energy shock that followed pushed the fuel prices sharply higher and added another layer of inflation risk on top of one that already existed, right? The RBA said it themselves, and if you can see here, in their own statement, they had a domestic inflation problem before any of this ever started, right? The global situation just made difficult decisions harder. Now, here is something that does not make the front page every day. The RBA is not saying that this is going to last forever. Deputy Governor Andrew Hauser said on the record that they expect inflation to return to the 2 to 3% target band by the end of 2026 or into 2027, right? This is, again, a temporary environment, but it definitely feels permanent right now. And that gap between how things feel and how things actually are is exactly what we are going to build our case around today, right? On the consumer confidence side, the Westpac Melbourne Institute Sentiment Index is sitting at 91.6 right now, okay? Anything below 100 means more pessimist than optimist in the survey, right? And if you see here in this data, the time to buy a dwelling sub-index is 82.9, right? That is more than 36 points below its long-run average of 120. So people are definitely scared to buy, right? The data is very clear on that, right? Here is where most people stop, okay? They see that number and then they walk away, right? I want you to hold that number because we are coming back to it in the next segment. And when we do, I think it is going to completely change how you're reading this market, okay? Now, Warren Buffett has one rule that most people have heard, but almost nobody actually applies. Be fearful when others are greedy. Be greedy when others are fearful, right? That time to buy a dwelling index sitting at 82.9, 36 points below its long run average. That is what fear looks like in data, right? Right now, most people are sitting on the fences, okay? And in a market with low buyer competition, where do you think the negotiating power sits, okay? There is a concept in property psychology called FOB, fear of buying early, okay? It's the internal voice that says that, what if prices fall more, okay? What if, should I wait, okay? And the research is really consistent on this, okay? FOB keeps most people out of the market at exactly the wrong time, because by the time that fear fades, okay, by the time headlines are positive again and everyone feels comfortable, prices have already moved, okay? Think about 2020, right? There was this pandemic, okay, all of a sudden, right? Borders were shut down, okay, and the consumer confidence were all-time low, right? Every commentator had a reason not to buy, okay? The people who bought into right markets in 2020, okay, are sitting on between 70 to 90% capital growth right now. The people who waited for certainty missed the entire run, right? And I want to make a point here that I think is really important in this specific moment, right? The environment we are in right now, okay, for example, the energy price shock, okay, the rate hikes, the cost of living pressure, all of that is feeding directly into construction sector, okay? It is becoming more expensive to build new homes, okay, which means the new supply that would otherwise bring prices down is going to be harder and slower to deliver, right? I will show you the data on that in the next segment, but the key insight is this: the forces that are creating fear in the market right now are the same forces that are making the structural case for well-located property stronger, not weaker, okay? Stronger. Now, understand this: property cycle does not care about feelings, okay? It moves on its own logic. You have supply and demand, migration, infrastructure, right? And right now, across right pockets of this country, those structural fundamentals are pointing in one direction, okay? Let me show you the numbers. Okay, so let's talk about what is actually happening underneath all of this noise, because the noise and the reality are very two different things right now, okay? We all know what has been happening in the world with the Middle East war, right? And we know what it has done to energy prices, oil prices, okay? What I want to talk about is what that actually means for the housing market, right? Because the implication most people miss is this: when energy costs rise and supply chains get disrupted, one of the first things that becomes harder and more expensive is building new homes, okay? The Housing Industry Association has already flagged that sustained cost pressure in this environment could add thousands of dollars to the cost of constructing a new property, okay? And if you can see here in this article, Australia was already not building enough homes before any of this unraveled, okay? Building approvals fell 7.2% in January this year, right? We had a 1.3 million home shortfall built up over 25 years before the current situation ever began, okay? What this environment is doing is making that supply problem significantly worse, not better, okay? And this is the central point I want to make. The forces that are making people nervous about buying right now are the exact same forces that are making it harder and more expensive to build, okay, the supply that would otherwise bring prices down, okay? For example, rising energy costs, rising construction costs, supply chain pressure, all of that flows directly into the cost of delivering a new housing, okay? Which means the structural undersupply that was already driving this market does not get resolved by this environment, okay? It gets entrenched further, right? Now, let's talk about the demand side sitting on the top of the supply problem, because this part has not changed either, okay? People are still moving here. Migration is still flowing into the parts of this country that do not have enough housing to absorb it. Rents are still rising. For example, nationally, rents are up 5.5% over the past year, right? And vacancy rates are sitting at 1.5% nationally, well below 3%. That represents a balanced rental market, right? That pressure does not ease just because consumer confidence is low. People still need somewhere to live, and there is simply simply not enough stock to sort of go around. Okay, now I also want to be honest about what this environment has done to consumer sentiment, right? Because pretending it has done nothing, it had no effect, would also be not straight with you. Okay, it has absolutely hit the consumer confidence. And if you can see here in this Westpac Melbourne Institute data, as I pointed out earlier, that time to buy a dwelling index is sitting more than 36 points below its long run average right now. Okay, that is again a significant number. It tells you that a large portion of the buyer market has essentially stepped back, right? People are watching news, they are feeling the cost of living pressure, and they are not feeling confident about making big financial decisions in this market, right? That is again completely understandable. But here's the investor's lens on the same number, right? When buyers step back, okay, competition drops, and when competition drops, negotiating power shifts. Properties that would have attracted 5 offers, 6 offers only about 6 months ago might attract only 2 offers today, right? The fear that is keeping people on the sideline is the same fear that creates better conditions for the people who are prepared to move through it, right? That dynamic has played out in every previous period of elevated uncertainty in this market, right? It is playing out again right now, okay? And then we have this longer view, right? Because in property, the longer view is the only view that really matters. Okay, the last time RBA ran a sustained rate hiking cycle, they moved 13 times, 13 consecutive hikes. Okay, and the markets with genuine structural undersupply did not collapse. They absorbed the pressure and they kept going, because interest rates can slow a market down, but they cannot reverse a structural imbalance that has been building for a generation. Okay, and as we have just covered, this current environment is actually making the structural imbalance worse through its impacts on construction costs and new supply delivery, right? And if you can see here in this piece from API magazine, published just about a couple of weeks ago, they put on a number on the screen that I think deserves to land. Okay, the total value of Australian residential real estate is $12.5 trillion. The total mortgage debt against all of that is $2.5 trillion, 20 cents in the dollar, across the entire housing stock of this country, right? That is again not a fragile market being held together by a cheap money, right? And good news. Okay, that is structurally sound market being temporarily overshadowed by genuinely difficult news cycle, right? Those are very different things. So the question is not whether this environment is difficult. It is difficult for everyone, right? The question is whether the fundamentals in the right pockets are strong enough to reward investors who move with clarity while everyone else is waiting for the world to calm down. Okay, and the supply data, the rental data, and balance sheet of this country's housing stock all point in the same direction. Now, I also want to be straight with you, right? Because I think a lot of property content skips that, and that does people a massive disservice. Now, this environment is not the right one for everyone, okay? If your borrowing capacity is genuinely stressed, if you're already feeling significant pressure from the cost of living, if you do not have the equity or the income buffer to comfortably service a property right now, this is not your moment, okay? Please do not force it. The last thing I want is for someone to overextend themselves on the back of a YouTube video, right? But if you have equity, if you have a strong household income, and if your debt is comfortably serviceable, if you have been sitting on the sidelines for the past 6 months or 12 months telling yourself you're waiting for the right time, I want you to really sit with this, right? What you are actually waiting for is a feeling that the world has settled down enough to feel safe to act, okay? And property market historically do not wait for that feeling before they move, okay? The investors who do well in environments like this are not the boldest people in the room. They're the most prepared. For example, their finances sorted before they start looking, okay? They have a clear strategy in mind before they make a call. They understand what the fundamentals of the target market really look like. They know what good value looks like when they see it, okay? And when the right opportunity comes up, they're ready to move. Because in the strongest parts of this market right now, quality stock in the right pockets is not sitting around waiting for buyers to feel comfortable. So here is where I will leave you, okay? You know what's really happening in this world right now, okay? You know what it has done to energy prices, oil prices, and cost of living, okay? You know the RBA market has responded with back-to-back rate hikes, and you know how that has landed on consumer confidence. All of that is real, okay? But what is also real, and I hope this video has helped you sort of see, is that the same forces driving that uncertainty are making the structural supply problem in this housing market significantly worse, right? For example, rising construction costs, falling approvals, a pipeline already falling short of what this country needs, okay? And obviously 20 cents in the dollar of mortgage debt sitting against $12.5 trillion of residential property, okay? That is not a market on the edge. That is a market with a very solid flow under it, temporarily overshadowed by a very loud news cycle, right? The people who look back at this moment in 5 years will fall into one of those two camps. The ones who say, I understood what was actually happening underneath the noise, and I moved while the competition was quiet, okay? And the ones who say, I kept waiting for certainty, and by the time I felt ready, the entry point had already moved well past me, okay? Now, if you want to understand what this looks like for your specific situation, for example, your borrowing capacity, your cash flow, which markets, and which strategy makes more sense right now, that is the conversation we have with our clients every single week, right? We are going to drop the link in the description below, jump on a call with one of our consultants, and let's walk through it properly, right? And if this video gave you a different way of looking at what is happening right now, share it with someone who needs to hear it, right? Thanks for your time, and I'll see you in the next one.